All right, now let's take a look at paying off debts. So there's two main strategies that are commonly used when it comes to paying off debts. The first one is the avalanche methods. So the avalanche method is paying off the loan with the highest after-tax cost first. Another way that we oftentimes look at this is paying off the loan with the highest interest rate first, and then taking the payment from that loan and applying it to the next highest interest rate loan. So this is very common, and we'll talk about this as we go through this lesson. A common practice is also to use the snowball effect. Snowball is very similar to the avalanche, but in the snowball, we're going to pay off the smallest loan first, then apply additional payments to the next largest loan. So we're going to list out debts, smallest to largest, and we'll just start picking them off in that order. So again, avalanche is really designed to produce the lowest cost of debt payoff. Snowball is more of a momentum strategy. Get an early success paying off debt and use that momentum to carry forward as the client continues to pursue their debt reduction goal. So let's look at this. This is an example of a debt inventory, okay? So in a debt inventory, we want to have the source of the debt, the interest rate, the balance, the payment, and then I also usually like to have the payoff date. Like, what is the date that the debt is supposed to mature? Now, when we're dealing with credit cards, there's really not a payoff date. They're a revolving line of credit. And so there's no set repayment date, right? Installment loans have a set repayment date, and a student loan is a good example of an installment loan. It's fixed for a set period of time, and making that fixed payment over that period of time leads to complete payoff by the maturity of that debt. All right, so here the client has a $500 budget. What order should we apply that $500 to pay off these debts? Well, if we were using the avalanche method, where we look at the interest rates, we're going to come here and say, hey, listen, the Visa has the highest interest rate, so it should get paid off first. The MasterCard has the second highest interest rate. It should get paid off second. And then the student loan would be paid off last. Okay, so we have a $500 budget, and the minimum payment on each one of these debts is $150. So $150 times 3 is $450. And so we're essentially going to be making an additional $50 payment to one of these debts. Because we're using Avalanche, we'll apply the additional $50 to the Visa card. And so we'll pay $200 to the Visa card and continue paying the minimum payment on the other two debts. Once the Visa card is paid off, we will apply that $200 payment that we were making to the MasterCard, right? And so now we're going to be making $350 payments to the MasterCard, while also continuing to make $150 minimum payments to the student loan. We'll make that $350 payment to the MasterCard until it's paid off, and then we'll apply the full $500 to the student loan until it's paid off. Now, if we were using the snowball method, we would use a little bit different approach. In the snowball method, we would go smallest to largest. So we'd pay MasterCard first, Visa card second, student loan third. Okay, so starting from the top, we would take the additional $50 that we have, and we would pay $200 to the MasterCard until it's paid in full, apply the $200 payment to the Visa, pay $150 plus $200, $350 to the Visa until it's paid off, and then on down the line. So that's the application of both the Avalanche and the Snowball. And having a debt inventory makes it really easy for us to sort our debts and see how applying a certain method allows us to make progress. Now, debt inventories are really, really important. Anytime we're looking at a debt reduction goal, that's the very first thing that we need to do. The next thing that we need to do is look at the client's other goals, right? And really consider, how does prioritizing debt repayment relieve constraints moving forward? Versus how does prioritizing debt repayment potentially produce constraints in the short term? So we really have to look at the goals in play, the timelines of those goals, and the priorities of those goals and make good trade-offs with regards to how much priority we give debt reduction and how does the priority that we give debt reduction affect our other goals, both in the short term and over time. Okay, and we'll take those considerations and we'll develop a debt reduction plan. And then we'll present that recommendation to the client with a good implementation strategy, and we'll start making progress towards eliminating those liabilities. Okay, so forms of revolving credit. Credit cards are obviously the most popular form of revolving credit. Other types of revolving credit are usually in the form of unsecured lines of credit, okay, and home equity loans. These are both really, really popular. Now, this mentions overdraft protection lines. Just about every single checking account in the world has an overdraft protection line up to a certain limit. That's kind of like the bank saying, hey, listen, we'll lend you a very small amount of money for a very short-term period to protect your account from going overdrawn, but you need to make deposits to pay off that debt that the bank covered for you in the near term. So very popular as well, but we don't usually think about that as an intentional revolving line of credit. Unsecured personal lines of credit and home equity lines of credit are very intentional and hopefully serve a positive and productive purpose for a client's financial situation. So an unsecured personal credit line is the exact same thing as a credit card, except it's made through a bank and you don't necessarily have a credit card tied to it. You could go into that line and transfer money into, let's say, a checking account, and then the money going into the checking account could be used for whatever purposes that the client intends. In that transfer, the balance on the revolving credit line goes up, and the client will be required to start making payments on that line of credit based on its current balance. These are nice because they're flexible, but because they're unsecured, they carry a little bit higher rates of interest. Now, a different option is a home equity line of credit. In this case, we're dealing with a secured line of credit, right? The home is securing the line. And when we're talking about home equity, we're basically saying, hey, listen, we have an equity position in the home. Does it make sense to withdraw from that equity position and use the equity that we built up in the home to help fund other goals? Now, this is nice, except for the fact that it puts another loan tied to the secured asset. And so it creates a little bit of risk for the client. But on the plus side, the interest on home equity lines of credit is tax deductible if the client itemizes deductions. So if you have questions about itemized deductions, feel free to shoot me an email and we can spend some time talking about itemized versus standard deduction. In a nutshell, you can only take one. And when you're filing a tax return on the client's behalf, you'll only take the biggest one, right? Standard is offered to anyone. Itemized deductions are usually the result of charitable contributions, mortgage interest, and property taxes. So if the sum of charitable contributions plus mortgage interest plus property taxes and other things that are available through itemized deductions is greater than the standard deduction, then you would itemize. And if you itemize and have a home equity line of credit, then the interest that you pay on that would add to the deductions that you're eligible to take on the tax return. So anytime we're dealing with revolving lines of credit that are issued by banks, they usually offer higher credit lines, more access to money, and lower interest rates. This is especially true on home equity lines of credit. Now, they function the exact same way as a credit card, right? If we have a line of credit, the bank says you can borrow up to whatever your limit is. Same thing for a credit card, right? Credit card says you have a $10,000 limit. You can borrow at will up to $10,000 from that credit card company for whatever you want. Lines of credit work the exact same way. So you would just take a draw on the line. If it's a bank issued line, that draw would go into your account by electronic transfer, and then that money would be available to use. But as soon as you take the draw, then the balance on the line of credit goes up and the requirement to make payments principal plus interest kicks into effect. So when do clients typically need loans and or lines of credit? One of the most common areas that clients need loans is when making big purchases. So cars, homes, and maybe even things like appliances, weddings, et cetera, et cetera. Another really common purpose for taking out a loan is debt consolidation. So taking high interest rate loans and consolidating them into a single loan at a lower interest rate. Very common practice, especially as part of a debt reduction plan. They may also take loans for investments, right? So when we think about higher education is an investment in human capital, right? That human capital allows a person to generate more lifetime income than they would have been able to without that human capital. And so usually loans for positive net present value investments are considered productive or good debts. That's not always true. We'll talk about that more when we talk about education specifically, but that's the general thought process. Homes kind of fall under that same idea, right? The home is usually the biggest asset on the average person's balance sheet and usually the biggest contributor to overall net worth, especially homes that have been owned for a long period of time and are potentially paid in full in terms of the mortgage. And so usually debt on homes is considered positive or productive good debt. And then loans on things like businesses and other income producing assets certainly carry risk. It's possible that the business could fail or the income producing asset doesn't pay off the way that it was expected to. But using debt for things like that is common because it's oftentimes evaluated and if determined to be positive, considered to be a higher benefit for the cost that's incurred. So if we can outperform the cost of the loan, then that would be a good debt in terms of businesses or income producing assets. All right. So when we're looking at consumer loans, the most common type of consumer loan is an installment loan. And installment loans are made for very specific purposes, and the terms of the loan are set up based on a repayment schedule. That repayment schedule and the interest rate determine the monthly payments, and that monthly payment is applied across the entire repayment period until that loan is paid in full. There are also non-installment loans, right? And some examples of non-installment loans might be interest-only loans, single payment loans, balloon loans. Interest-only loans and single payment loans are exactly what they sound like. The lender will say, hey, listen, here's money that you can borrow over a set period of time. You're only paying interest only, right? And after that set period of time, you're probably going to refinance that loan into a new type of loan that is more likely than not going to be an installment loan. A single payment loan is similar. We're going to front you the money. You don't owe anything to us right now, but after the no payment period expires, then the entire loan is due in full at that point in time. That's single payment. And then balloon loans, small payments over the course of the loan on the front side. And then towards the back end of the loan, you have much bigger payment requirements to pay the loan on schedule. So when we're looking at loans for clients, here are some common sources, right? Banks and credit unions, very familiar with. It's also possible that we could take loans from brokerage companies and life insurance companies. These are much less much less popular to the average consumer, but financial planning firms might have access to opportunities or advise clients to create opportunities for loans from these two sources. We talked about a little bit earlier, loan options that may be available through retirement plans. And then we're going to spend a lot more time in the housing section of this lecture talking about different forms of home equity loans, how they function, and more details on those products. So like I said earlier, a good rule of thumb when advising clients, especially on acquiring debt, is to make sure that when using debt to purchase a product, that the credit payments don't outlive the product's use, right? So the product should last longer than the payments. And as long as that's true, then we have the best chance possible of using debt effectively to improve a client's financial situation. Well, that concludes our overview of paying off debts. We're going to move on in the next lecture to talk about housing, and that will conclude Unit 4.